Our favorite medical REIT, Medical Properties Trust, has had a bit of a down week this week. As you may have heard, they just announced their regular quarterly dividend, which is coming in at 8 cents, down from the previous 15-cent regular quarterly dividend. Of course, this was probably already priced in because they had announced with their latest earnings that they had agreed to cap the cash portion of the dividend at 8 cents. And if anything, the only real mystery was, would there be a stock portion of the dividend, or would they perhaps go lower than the 8 cents, since what they had agreed was to pay out cash up to 8 cents. Now, it looks like they did end up paying just exactly 8 cents on the dot, which was probably the most likely outcome of this dividend situation. Speaking on the matter of dividends, data feeds will not be up to date on what the dividend is going forward. Normally, data feeds are sort of retrospective, right? So they will end up showing you either an annualized dividend based on what the last couple quarters have been, or just on what the trailing 12 months have been. In which case, with MPW, since they had been paying 15 cents for a while, it's still showing 60 cents as the annual dividend. And obviously going forward, it's not going to be most likely 60 cents over the next 12 months. And this is where I think a lot of people who only just, they look at the yield and they're like, oh, that's a great dividend, I'm going to buy that. This is the fallacy that they run into. They see the percentage yield and what the data feed says the annual dividend is, and they just think that that's a given over the next 12 months. This is a fallacy that yield max people tend to fall into, especially, where those funds, it'll basically show you what you got over the last 12 months. And what they don't realize is that with the NAV erosion, which does happen, what you're very likely to see is that the dividend actually drops at a similar rate to how the NAV erodes. So what you'll end up seeing is, into the future, you'll have a dividend payment that is actually lower. So if you end up looking at the annual dividend a year from now on those, it will show a lower number than what you had seen the prior year when you first bought the stock. That's why it's very dangerous to buy things only based on yield without actually understanding what you're actually buying, what's underneath it. In the case of MPW, you've got, hey, it's land and buildings, right? These are medical facilities with licensed beds. And right now, actually, is a pretty decent time for healthcare operators. Like, a lot of them have started to round the corner after the pandemic. Steward is just one of the few that was so poorly managed that it just couldn't make it without going into Chapter 11. Now, the 800-pound gorilla in this room is that you have interest rates at higher levels than what they were only a few years ago. And you have a debt wall. And you have lowered credit ratings. So at the moment, outside of Steward, the things that will affect MPW sort of on a macro level, right, are interest rates. Because obviously, if rates are higher, any type of secured debt they take will be at more or less favorable rates, depending on what the interest rate environment actually is. Also, the market value of assets and cap rates. So if they were to sell assets, or what the value would be in terms of loan to value on any assets, that also changes with interest rates, because asset buyers will pay more for physical assets in times where interest rates are lower because bonds are less attractive. Assets like buildings for rent are more attractive during those times. But when it comes to refinancing potentially debt that's coming due in the next, say, 3 years for Medical Properties Trust, the credit rating is probably one of the biggest pieces of the puzzle. Because even if rates are lower, the Fed drops them by 50 basis points or something in the near term, that doesn't really help that much with MPT's ability to manage their debt loading if they are still below, well below the investment grade credit ratings they would need to secure realistic and low interest rates, which their business was thriving on prior to Steward's implosion. So that is kind of the mix of factors at play here. Now, I do think that rates coming down will generally see some money flow into the REIT sector, and MPW might get a little bit of a lift from that. But let's be honest, a 50 basis point cut on its own in the short run isn't going to just magically turn everything around. But it would be one of many things that would help contribute to a slightly better environment for them. So we need to see favorable resolutions with Steward and to a lesser extent Prospect, lower interest rates, maybe improved liquidity, improved implied values of their assets, and hopefully a credit rating increase when it becomes clear that they're not a substantial default risk. So those are, I think, just the things that are in play right now. Let me know any thoughts in the comments below. As always, I would like to thank you for making it to the end of the video. Please ensure that you both like it for the algorithm and subscribe to help me reach 3,000 subscribers in the blink of an eye. Also, I'm on the X platform at Mr. Macho Mog. It used to be called Twitter. It's now called X. I'm trying to get my first 500 followers there. Very important that I do that. Also, Discord, link in the description as always. And catch me every Saturday, 8 p.m. Eastern, Cashflow Kings Live. If you're not subscribed there, you're just missing out. Let's just be honest. And if you want to support the channel directly, you can become a member. My prices start as low as $1 because I don't want anybody to feel like price is a thing that's preventing them from being a part of this if they actually really want to be. So with all that being said, take it easy and have a happy Friday.